This is a special real estate market update for our free members and subscribers. We don't normally do public reports like this because it's not fair to our paying members, but there's so much bad real estate advice coming from the so-called experts that it's time to call BS on all of it and speak out. I'm sounding the alarm just like I did over a decade ago, long before the last crash hit. All you hear these days is how strong the real estate market is, that there's not enough housing inventory and properties are getting multiple offers as soon as they're listed. That is not what's happening in most markets, not even close. In fact, it sounds an awful lot like what we all heard leading up to the last crash. They're completely missing today's reality. We'll come back to this hot and cold market map in a minute. You'll see exactly where the profitable markets are, where it's still safe to invest, and I'll also show you the markets that are weak and crashing right now, the ones you need to avoid, and how to spot the difference so you can protect yourself. Most of you look forward to the list of declining markets we publish each quarter. We cover about 95% of all U.S. real estate, over 400 local markets. This was the current list at the time I recorded this video. Real estate values on a real or inflation-adjusted basis declined in 148 markets. That's over a third of all U.S. markets. These are 3-month declines. These percentages here on the right, you can multiply them by 4 to get a rough estimate of the annual rate of decline. And if you think that's troubling, it gets worse. We went through this list to see where all these declining markets were concentrated. You can see here, it's extremely broad-based. The yellow highlighting means that state had at least one declining market in the last 3 months. Remember, you don't need a housing bubble to have a catastrophic market crash, and every crash is catastrophic if it happens in your market. What's eye-opening is that this new crash is happening at a time when the average of all U.S. markets is looking pretty good, as you'll see. That's why you haven't heard anything about this. I'm the only one looking underneath the facade of national statistics and analyzing every local market. It's a very different picture when you actually drill down into these local markets. Here's how the real estate boom and bust cycles used to look. Historically, weak or strong areas would be clustered together geographically, like Texas, Oklahoma, and Louisiana. They lost around a third or more of their value in the 1980s, while the entire New England region gained 50 to 100% in value. This is a map showing inflation-adjusted real estate appreciation rates by state back in 1987. Red, orange, and yellow colors mean super hot, appreciating real estate, like you see here in New England. See how the entire region was red hot? At the same time, you'd see other regions losing value, like these oil-rich states here. Pink and purple means declining real estate prices. Then, in the 1990s, the cycles reversed, as they always do. See how real estate prices for the entire New England region are collapsing? New England was sucking wind. The red, orange, and yellow hot market colors turned into pink and purple crashing markets. That's how things used to work. Geographically based big market cycles affecting entire regions. As a real estate investor back then, you could have some confidence that you'd be okay so long as your overall state or region was doing good. Not anymore. That's what's changed. You can see here that 46 out of the 52 states, we included DC and Puerto Rico, are highlighted in yellow. 46 states, almost 90%, have at least one declining market right now. Even when you look at annual data, which is more conservative than quarterly but also slower to catch any changes, we still have 31 states, 60%, with at least one market where prices are actually lower than they were a year ago. Notice I didn't say states with at least one weak or flat market. I said declining. It's widespread, from coast to coast, and it's serious. You now have weak and crashing markets adjacent to hot markets all over the country. Investors will never see this coming, and it won't make the evening news until it's already slapped everyone in the face. Demand is falling on a localized basis right now, and no region is safe. Now look at the same map near the start of 2018. Lots of mediocre blue colors. I mean, all I've been hearing is the polar opposite. The economy is booming and realtors are running out of houses to sell. But if the real estate market is so hot, why aren't we seeing greater demand, stronger appreciation? Red and yellow colors in this map. I'll tell you why. Local market psychology, the driver of all real estate cycles, can and has already turned on a dime in markets all across the country. Unlike the good old days, cycles have become much more homegrown. It's now a radically different picture when you actually look inside each state. We now have strong and weak markets in the same state at the same time. The net effect when you average them together statewide is what you see in this map. Many thousands of you watching this have been following me since before the last crash and already know our track record for identifying the exact start and the exact end of virtually every local real estate cycle in the U.S. For anyone new to Housing Alerts, hi, my name is Ken Wade, and just so you know, I'm not some clown making wild, unsubstantiated claims on the internet. I've got an MBA from the Harvard Business School, I'm a CPA, and I've done more hands-on, in-house commercial and residential real estate deals over the last 30 years than just about anyone out there. From flipping vacant lots and houses to syndicating and operating 1 million square feet of commercial office and retail space. I've built multi-state acquisition and sales agencies, and I've developed huge subdivisions spanning thousands of acres. I've done it all. And more important, I'm a number-crunching geek. I've spent most of my adult life figuring out how to accurately and reliably predict local real estate cycles because my success depended on it, and so does yours. I'll show you right here, right now, what to look out for and how to avoid the financial havoc it'll wreak. We identify current and future hot and emerging markets across the country using our time-tested and proven market algorithms. Here are some of the best markets as I record this video. Seattle, Washington, and Tacoma, Washington. Actually, most of Washington State and Oregon are pretty hot. See all these markets in red? For informed investors, these hot markets will create more wealth in a few years than other investors, those who ignore the market cycles, will ever create in a lifetime. Here's some more hot markets. Coeur d'Alene, Idaho. Salem, Oregon. Fort Worth, Texas. Nashville, Tennessee. Daytona Beach, Florida. Dallas, Texas. Salt Lake City, Utah. Eugene, Oregon. Lakeland, Florida. Palm Bay, Florida. Grand Rapids, Michigan. Provo, Utah. Colorado Springs, Colorado. Muskegon, Michigan. And Lincoln, Nebraska. They're spread all over, from Florida to Oregon and from Texas to Michigan. And yes, you heard that right. Even some of the old Rust Belt markets have been coming back to life. You should only invest in hot markets like these. It's the only way you can use real estate to build quick wealth and minimize your effort and downside risk. There are plenty of other high-profit, lower-risk markets right now, as you can see here. This is our new Hot Market Finder tool. There are millions of calculations that go behind what you see here. It's so powerful we just moved it onto a special new platform. I can now show you, visually, in a few clicks, what would have taken all day to explain. What you're looking at is a ranked list of all U.S. markets. This one is ranked from best to worst using our Master Score indicator. Don't worry about these other columns right now. There's some of the other indicators we use to track and predict market cycles. For now, just get a sense of where all these hot markets are. See how they're spread all over the country? If you know how to find them, there's pretty much always a hot or emerging market where you can create a lifetime of wealth in a short period. We can also reorder this list by clicking up here. We're now looking at the worst markets in the U.S., and that's what I want you to focus on. We're at the very early stage of a unique type of market reversal, called a stealth or selective down cycle. It doesn't matter what name you give it, it'll feel just like the last crash if you get blindsided by it. See how these crummy markets are also spread all across the country? In different states? That's the troubling part. Here they are on that same Master Score map. This time we're looking at the weakest markets in the country, those with the lowest scores. Casper, Wyoming, Watertown, New York, Bismarck, North Dakota, Charleston, West Virginia, Enid, Oklahoma, Gadsden, Alabama, Williamsport, Pennsylvania, Odessa, Texas, Johnstown, Pennsylvania, Peoria, Illinois, Atlantic City, New Jersey, Victoria, Texas, Wheeling, West Virginia, Cape Girardeau, Missouri, Valdosta, Georgia, Farmington, New Mexico. It's unusual when the crummiest markets in the country are popping up like whack-a-moles in different states, creating pockets of extreme weakness alongside otherwise healthy local markets. You can't find safety simply by being in a strong state or region anymore. In the last crash, by the time most of you in the media became aware of what was going on, it was already too late to save yourself. This crash will be even harder to spot because it's so local. Instead of a huge tidal wave, this one seems to be more like guerrilla ambush, picking off investors and markets one by one. Let's use my market as an example. I live in Ocala, Florida. This shows the master scores for the previous quarter. And here's Ocala. See all the red-colored markets nearby? Those are all great wealth-building markets. Except this blue one, the Villages. It's one of the weakest markets in the country, and it's right next to me and all these other hot markets. That's not normal, and I'm starting to see similar anomalies all over the country where you'd least expect it, and getting worse. I began warning locals how the villages were starting to fall off a cliff 3 years ago. Look how different these two are. A quick scroll through their market report tells you all you need to know. For most of last year, Ocala was in the top 20% or so nationwide. The master score, the TAP score, THAR, total home appreciation rate, all of these gauges were showing Ocala with top rankings until this most recent period. It's not until you get down here to the star indicators that you start seeing any weakness creeping into the Ocala market. These red, yellow, and green lights, they're like advanced warning indicators. As long as they stay green, you can go back to sleep, nothing to worry about. Compare that market report to this next one, for the villages, 6 miles away. It shows a completely different story, doesn't it? These ranking gauges look horrible. The TAP slider balls are all the way left, at the weakest level. The villages is, and has been, one of the worst markets in the country, literally in the bottom 5 or 10% for most of our indicators over the last couple years. The star indicator here looks nasty, red everywhere. They actually started turning from green to red back in 2014 and deteriorated ever since. It's not just the villages. Look at all these crummy markets. We're looking at the hot market finder in reverse order again. There are lots of other weak and declining markets we didn't go over. You need to avoid them all. Check them out here in this left column. Here's the villages. Its master score is in the bottom 11%. That's what this 11 means in the first column. It's percentile. To the right, you can also see where it stands with these other market indicators. Moving further right, you see how it ranked last quarter and a year ago for these same indicators. As a market's rank gets weaker, its numbers drop. They're also color-coded. Dark red is the lowest, weakest color. Dark green is the strongest. Take a look at these other crummy markets. Hopefully you're not invested in them right now. As we move away from the very worst markets, you start seeing some other colors coming in, especially in the year-ago columns on the right. Here's an interesting one, Napa, California. I mean interesting in a bad way. See these different colors off to the right? How in the previous quarter, a couple of Napa's indicators were yellow that are now red, and a year ago, they were light green. In Napa's case, they're going from more green and yellow on the right to more red now. That means it's quickly getting worse, not better. It's just an easy visual way you can scan for emerging, or in this case, falling markets. Maybe the wildfires in Napa contributed to all the red. I've seen natural disasters like floods, fires, and hurricanes go both ways in terms of real estate prices. In some cases, it kills longer-term demand and prices fall. In other cases, the reduced supply pushes prices higher. Anyway, it's definitely not a market I'd be in right now. It's not a complex decision when you have the right tools. With a quick scan, you've got your answer, don't you? Getting caught in a down cycle, or even a flat cycle, just sucks the life right out of you. It can steal your retirement right out from under you. At best, it'll just waste years of your life and put you back at the end of the line when you could have been building huge wealth. Don't leave it to chance. Investors in other markets, even in nearby markets, will continue to make a killing while you're getting clobbered next door in a crashing market. The crash I'm talking about is much more discriminatory this time. Here's why you won't even see it coming unless you know where to look. This is a chart of what most people call the U.S., or National Real Estate Market. Now, I don't want to argue semantics, but before we go too far, there's something you need to know about the U.S. market. It doesn't exist. There's no such thing as a U.S. real estate market. You can't invest in the U.S. market because it's just an average of all the local markets. You can only invest in specific local real estate markets, and every local market is different. No two are ever the same. So here's what the average of all markets in the U.S. looks like. This black horizontal line is the zero appreciation line. When the blue line is above this black line, it means home prices, on average, are appreciating. We can even fill in all the times the blue line is above the zero line to show what an average national upcycle looks like. Then when the blue line is below this zero line, it's in a down cycle. We can show that in red. See how investing in real estate is always a 3 steps forward, 2.5 steps back sort of thing? See that? You create wealth in the green areas, and you lose wealth in the red zones. If you've heard that real estate is very cyclical, this is what they're talking about. And it's the same problem I've spent most of my life solving, avoiding the red periods. Not taking the 2.5 steps backwards is what separates the wealthy from the wiped out. Don't give all your profits back or wind up in foreclosure and bankruptcy in every down cycle. Using the national market to guide you could actually cause your demise. It's completely misleading. Let me show you. The first questions asked by most investors are usually something like, how's the U.S. real estate market doing? Are we in another bubble? Or when will it crash again? So I'll answer those questions for you and explain why they're exactly the wrong questions to ask. You're looking at two of our primary market indicators for the entire U.S. The top one is our STAR indicator. These red, yellow, and green traffic lights measure market momentum, or energy. If you've subscribed to our free training, then you've probably already seen the videos on how this works, so we won't go over it again. For the national average, this STAR indicator is currently showing some minor weakness in the short term, on the left here. But the longer-term indicators, the columns here on the right, are still green. Generally, that means the market's doing fine, but you need to keep a closer eye on it going forward. We'll come back to these green traffic light signals later. For now, just make a mental note that when we talk about the long-term triggers, we're talking about these on the right side. The bottom tool is the Technical Analysis Point Score, or TAPS indicator. The slider ball is currently in between the strong and neutral zones, and the arrows on the right side of the ball indicate it recently moved from the strong position on the far right, getting a little bit weaker. The U.S. chart is also confirming what these indicators said. It looks pretty good as I record this video. The average real appreciation for all U.S. markets has been hovering in the 4% range for most of the past 4 years. You can see that it's been fairly stable since 2014. That's a good thing. So why the warning about a discriminatory crash when the U.S. average market looks okay? Ever heard the saying, you can drown crossing a river whose average depth is only 1 foot? Some parts of that river may be slow moving and 6 inches deep. Other parts might be raging swift water 10 feet deep, right? That's the problem with averages. It's the same for real estate. Looking at an average of all 400 major real estate markets in the U.S. isn't going to help you avoid financial ruin or help you find the next wealth-building emerging market. Remember that list of weak markets I just showed you? Imagine you were investing in Casper, Wyoming, or any of these other crummy markets we saw. Don't try to tell them we're in a strong market. In Casper, the crash is well underway. Here's a quick scroll through its summary report. Almost all of these gauges for Casper show it ranking in the bottom couple percent. I'd bet even right now most investors and homeowners in Casper are clueless about what's happening in their own backyard. A quick 30-second scan of this report tells you everything you need to know about Casper, Wyoming right now. Stay away from it. This down cycle will end someday. Once again, it'll enter its next wealth phase cycle. Whenever that happens, you'll be the first to know. You'll see it coming. Until then, stay away. Run from this market. It's already lost its momentum. See all the red lights over here in the far right, the long-term indicators? Its TAP score is in the weakest position. The slider ball is stuck all the way over to the left. Quite a different picture from the average U.S. market we saw a minute ago, isn't it? Now look at its wealth phase chart. It's been losing around 5% of its value each year since its wealth phase ended. This is the same type of appreciation chart we just looked at for the U.S. average. But at the local level, our algorithms add these green wealth phases to the chart. And to be clear, these green areas are added in real time, whenever we upload new data for our members, not years later. The Casper market rolled over and went negative in early 2016. Even though I've never set foot in Casper, Wyoming, I'm pretty sure that I know more about the Casper crash than any realtor or any local investor knew, or even knows today. You probably know more about the Casper market than any local right now. There are hundreds of better, safer markets that can make you wealthy. Investing in Casper right now, or trying to catch the bottom without first looking at these indicators, is foolish. Why suffer through the big financial losses, the stress and aggravation, and all the extra work? Wait for the market to come to you. It's really that simple. I see it all the time. Locals not knowing they're in the middle of a red-hot market or a crashing and burning market. Maybe they're just too close and can't see the forest. Usually, they just don't know any better. I mean, seriously. How do you know what's really going on in your market? The media? Realtors? Median home price or MLS stats? Fundamental data? Zillow? Really? If you answered yes to any of those, financial disaster could be right around the corner. At least watch my earlier training videos so you'll know what a huge mistake you're making. You should deal only in cold hard facts when it comes to your financial survival or your retirement nest egg. In the few seconds it takes to pull up Casper's market report, or any market report, you've unleashed a lifetime of world-class research, 40 years of backtesting, and millions of high-level calculations. So let's look inside a couple states to show you how the stealth crash is hitting them. Let's go back to that hot market finder again. Let's narrow our search to only the Texas markets. Okay, up here at the top we've got some crazy strong hot markets. Fort Worth, Dallas, Sherman, all of these with a lot of dark green and high rankings. By default, it ranks them by our master score, but you can rank on any of these indicators just by clicking on them. Look what happens as you scroll down. It's not long before the green turns to yellow, a lot of mediocre markets that won't make you wealthy. Then a little further down, they start turning red. That dichotomy, the Dr. Jekyll and Mr. Hyde split personality so many states are showing, is the reason you should be getting alarmed. Texas has red-hot markets in the top 5 or 10% of all markets nationwide. And at the same time, it's got some of the worst markets in the country, the bottom 5 or 10%. Now, if it were only Texas, I wouldn't be as concerned. It's a big state. Let's take a look at Georgia. Athens, Chattanooga, Atlanta, and a few others are looking okay. Nothing super hot in the top 5 or 10%, but a few markets in the top 25% nationally. Still good enough to create major wealth in this market. But as you move down, the green shades start turning to yellow, and then red. You've got some seriously weak markets, Macon and Valdosta. There's not even 100 miles separating Atlanta or Athens from Macon, yet they're on different planets when it comes to creating wealth or getting financially clobbered. Let's look at another one, Tennessee. Nashville still looks great. We mentioned Nashville years ago when it hit our radar screen. It's still kicking butt as I record this, in the top rankings. You can click on any city in this list to see its report. Here's what a red-hot market looks like. Its gauges are in the top percentages across all indicators. Master score, TAPS, THAR. The slider balls are all the way to the right in the strongest position. Below that, the red, yellow, and green star and momentum indicators look just about perfect. Remember what I said about when they're all green? You can go back to sleep. Whenever a market finally does start rolling over, and every market will sooner or later, it has to start showing up in these short-term indicators first. You'll start seeing a pattern of increasingly yellow and red lights growing from left to right. And at the bottom here, you can see Nashville is in its 4th wealth phase cycle since the early 80s, the best it's looked in 30-some years. Now, make a mental note how Nashville's chart kind of looks like a yo-yo, up, down, up, down. See the 4 wealth phases? Distinct times you could make money? Okay, so now that we've found a great market, let's look inside it, drill down into its micro markets. So we'll scroll back up, pull up the maps. We want zip code maps this time. This shows all zip codes in the country that had enough real estate transactions to generate good data. Let's zoom into Nashville. Okay, here's Nashville close up. I've made the zip level maps a little transparent so you can see the roads and towns to get your bearings. I've only been to Nashville once, but I can already tell you, in literally 15 seconds, the best places to invest. Here's the zip code overlay. You can see here, almost all of Nashville's micro or submarkets near city center are appreciating nicely, some more nicely than others. The orange and yellow zones are seeing mid-double-digit annual appreciation. Those are the first places I'd target my efforts. But the green zips are good as well. With 10 to 15% annual appreciation, it doesn't take long for you to quadruple or even tenfold your investment with the right amount of leverage. That's the beauty and the power of combining real estate leverage with an appreciating market. And here's what it looked like in the prior year. Similar pattern, more or less. The downtown areas and those to the north are appreciating the fastest. Now, let's go back to the most recent period and zoom out. See all the surrounding area. Once you get away from downtown Nashville, you start seeing some flatlining and even declining zip codes, the dark blues and the purples. Even if you've never been to Nashville, you probably already know more than the locals. Think of your own market, or any market you invest in. How do you really know what's going on without these tools? Okay, back to the Tennessee Hot Market Finder. Memphis is the other top market. Looks like it's finally starting to rank in the green. See how it's moving from mostly yellow a year ago to mostly green across different indicators? That's a good sign. It's steadily getting stronger. If you opened its market report, you'd see that Memphis doesn't look anything at all like Nashville. It's been flatlining or declining for most of the last 20 years. Remember Nashville's wealth phases? That yo-yo looking chart? The Memphis real estate market is completely different. It's hard to find any similarities between the two, isn't it? Like so many other states, Tennessee also has a Jekyll and Hyde side. See these red, low-ranking markets at the bottom? Johnson City and Bristol, some of the worst appreciation in the country. And if you look at Nashville's other nearby markets, here's Nashville in the center, it gets even more Jekyll and Hyde-ish. Right over the Alabama border, 100 miles from one of the hottest markets in the country, you've got some of the weakest markets in the country. Florence, Decatur, Huntsville, Gadsden, and Oxford, all in Alabama. Here's Johnson City and Bristol. It looks like Nashville is almost surrounded by weak markets. 150 miles to the north in Fort Knox and Evansville, and over here to the west in Missouri and Arkansas. Can you see how radically different your investment results would be? Your success or your failure, 100 miles to the south or a couple hundred miles in any direction. Wealth building markets adjacent to wealth destroying markets. So you get the idea. More than ever, individual market selection matters most. You can't get by just targeting hot states or regions anymore. You've got to drill down to the local city level. That's always your starting point. After you've selected your market, only then should you drill deeper into zip codes. Remember, real estate cycles are dynamic. These hot markets will one day become weak, declining markets and vice versa, as you'll see in a moment. That's why they're called cycles. Now, this is our state radar tool. It's similar to the hot market finder, but for states, not cities. Normally, you'd use this to find early-stage emerging states. Then you drill down to find the hottest markets in that state. Using the same master score ranking we've been using, you see Washington, Utah, Idaho, and Tennessee are the top states. Let's reverse its order. So now we're looking at the weakest states on top. We already know there's localized market weakness in virtually every state. That's troubling enough. But now we're also seeing entire states turning negative, losing value. We're getting the worst of both evils. And just like the local markets, these declining states are spread out all over the country. This map shows colors based on statewide master scores. It's a much better predictor of future market cycles. Unlike spot appreciation rates for a single point in time, this master score is more forward-looking. North Dakota just turned negative. Wyoming first went negative a year ago and is still losing value. West Virginia's been negative for over a year. Delaware just rolled over into the negative category. Connecticut's been losing value. We're just hugging the break-even line for about 2 years. All of these states here you see in pink and purple are already losing value or could soon turn negative. Oklahoma, Vermont, Mississippi, Louisiana, New Jersey, Alabama, Illinois, Virginia, and Maryland. Alaska already went negative and Hawaii could be close behind. These 16 states, on average, already have statewide falling real estate values or close to it. That's nearly a third of the country, and no one seems to know about it. There's serious trouble on the horizon for uninformed real estate investors and homeowners. 46 states now have one or more local markets in decline. Entire states are rolling over and going negative. There's still plenty of time to protect yourself. These are our earliest warning indicators. But when it hits the news, it's already too late. Now that you know how to find the best and worst markets, the simplest way to get stinking rich from all this is to simply follow their wealth phases. Here's how these wealth building phases work, just going alphabetically with some examples. Allentown, Pennsylvania. Pay attention to the blue line. Note how each market is different. See how Allentown's green wealth phase started in 2001 and ended in 2007 and hasn't started a new upcycle, these green shaded areas, yet? Compare this with the next one, Ann Arbor, Michigan. Ann Arbor's green wealth phase started in 1995, almost 6 years before Allentown, and ended in 2003. As Ann Arbor's 8-year upcycle was winding down, Allentown's wealth phase was just beginning. Look how Ann Arbor completely missed the housing boom. When many markets were red hot in 2005 and 2006, Ann Arbor started dropping like a rock. Compare that to Asheville, North Carolina. It had a 13-year wealth phase. Next is Atlanta. Look how different its blue signature is. Its wealth phase ended in 2003, just as the housing boom was getting started. You can see how all the red icons here, down here on the right, were telegraphing way in advance how Atlanta's upcycle was coming to an end in 2002 and 2003. Atlantic City. It had a powerful upcycle starting in the late 90s, then rolled over and went negative in 2007, and to this day has never recovered, over a decade of steady home price declines ever since. Bakersfield, California. Bakersfield had huge appreciation and huge declines, over 30% per year at its peak and trough. A lot of California markets led the recovery back in 2012, but Bakersfield's recent wealth phase has already petered out. See how the green wealth phase area ended in 2016? And remember, these green shaded areas are added or updated in real time by our algorithms every time we upload new data. Baltimore still hasn't entered a new wealth phase. Same for Camden, New Jersey. But even Detroit, Michigan is in a wealth phase now, after completely missing out on the last housing boom. See how each market's signature, the blue line, is different? All markets move in cycles. No cycle lasts forever. That's why you can't buy and hold forever. It leaves you vulnerable to the same personal financial disasters that wipe out most investors. Those who do survive spend years, decades digging out. Buy and hold cripples your cash liquidity, extends your legal exposure, and leaves you with no options other than hoping and praying. The old-fashioned way to buy and hold is simply ludicrous in this day and age. That's hard to believe, I know. It's the opposite of what we've all been taught. There is a better, safer, easier, faster, and exponentially more profitable way to real estate wealth and financial independence. Wait until you see this. First, we'll start with Las Vegas and invest the old-fashioned way, buying and holding forever. We'll use $20,000 as your down payment, get an interest-only mortgage loan for 85% LTV, loan to value, and buy a house. I know a lot of you can do better than that, using little or none of your own cash, but we'll be conservative and assume you invest 15% into the deal. So you buy here in Las Vegas in 1980. For simplicity, we'll assume rents equal your carry costs like interest, taxes, maintenance, and management. You simply break even on cash flow. We'll also do something unheard of for most real estate investors. We're going to pay full retail price. So no complex acquisition efforts, no finding motivated sellers, none of that stuff. Just find an average realtor and buy an average property. Or buy a property from one of those turnkey outfits. You can even invest in those new crowdsourcing real estate investment funds. But focus on deals that let you choose specific hot or emerging markets. It can't get much easier than that. In this example, you held that Vegas property until late 2017. Ready to be shocked? You only made $3,337. That's your real or inflation-adjusted profit after owning it for all those years. I don't know about you, but I'd be bummed out. I mean, it's better than losing money, which was the case until just recently in Vegas. You were underwater for most of those years, unable to sell it without coming out of pocket additional cash just to unload it. You can see from this chart, Las Vegas real estate appreciation basically hovered around the flat line for decades until that huge spike in 2005 and then went into an even more spectacular crash. This most recent recovery barely got you back to break even. The old-fashioned buy and hold method, at least in Las Vegas, only got you years of headaches and stress, but did nothing for your wallet. Now, are you ready to see the power of investing with the cycles? Letting the market do all of your heavy lifting? You do the same as before, except for one simple change. When the wealth phase chart turns green, you buy. When it ends, you sell. Since we're limiting ourselves to only the Las Vegas market in this hypothetical, you're either completely invested in real estate or you're completely out of the market, sticking your profits in the bank and sitting on the couch waiting for the next upcycle. So you get your first buy signal in 2001, you cash in your bank CD and buy your first property using that same 85% LTV mortgage loan. We use the exact same assumptions here as we did in the buy and hold example, so it doesn't really matter what those assumptions are since they're the same for both scenarios. It works for all investing strategies. You don't have to use a down payment, and you certainly don't have to pay full retail price, adding no value like we assume in these examples. So you ride that big appreciation wave until the green wealth phase comes to an end in 2007. You sell your property, put your profit back in the bank, and wait for the next wealth phase to begin, which happens in 2013. Once again, you invest that principal and interest in more real estate, paying full market price, and you ride the next wave up. Near the end of 2017, even though Vegas is still green, in this example you sell, so we can figure up your profits. You ready? Your total profit from investing intelligently jumps to $1,346,572. You made $1.3 million more than that $3K you got from buying and holding. Your overall risk was dramatically cut. You were only in the market for 2 short periods and avoided the huge crash entirely. Okay, let's do it again, this time in Seattle, Washington. Seattle, Washington is currently one of the hottest markets in the country. Let's see how timing those wealth cycles work. So we buy here in 1980, sell near the end of 2017 at the end of this chart. The buy and hold strategy makes you $177,154. Compare that to investing with the cycles. Now, inside Housing Alerts, there are other tools that give you even more precise local market info. But for these examples, remember, we're limiting our actions to only that one simple rule and that one simple tool, the wealth phase charts. You buy here in 89 and sell in 91. Stick your profits in the bank and wait for the next cycle, which begins in 1997 and ends 10 years later at the start of 2008. After the last crash, the wealth cycle turns green again in 2013, so you ride that appreciation wave once again. You sell near the end of 2017, just to wrap up this example, even though Seattle's upcycle still has a lot more room to run. You ready for this? Avoiding the down cycles got you a $3,035,640 profit. That's a 15,178% total ROI on your $20,000 investment. That works out to a 400% average annual return. Just divide the 15,000% total return by the number of years. Any way you want to look at it, it's $2.8 million more than buy and hold. How often does that happen? You do less work, you take less risk, but you make more profit, a lot more profit. So be honest. Are you thinking I must have cherry-picked Las Vegas and Seattle because they're so good? Come on, be honest. There is nothing special about those two markets. It's just simple math. What you're seeing is the power of leveraged appreciation. That, and only that, is why real estate is said to create the most millionaires. It's not from cash flow. It's not from buying it right. And it's not from holding it forever. It's not from flipping and wholesaling either. It's from owning or controlling a high-valued asset, like real estate, with little of your own cash. That's the leverage part. And having that high-valued asset increase in price. That's the appreciation part. The leverage part is easy. Just get a loan. It's mastering the appreciation part that was hard, until now. Put your seatbelt on because we'll zip through some more quick examples. Same assumptions, same time periods. Los Angeles, California. So you buy here in LA in 1980 and hold it through all these ups and downs, and you sell it here in 2017 to calculate your buy and hold profits. How'd you do? You made, call it $160,000, $159,733. Would you be happy with that? It's really not that impressive when you realize how long it took you. In this case, you're looking at an average annual ROI of 21%. Riding out those down cycles kill you. And remember, a 50% decline requires a 100% gain, a doubling of value, just to get back to break even. A lifetime of hard work gone in a single down cycle. Once again, this time, you only buy when the wealth phase turns green inside Housing Alerts, and you sell when the wealth phase ends. That's the only change. So you buy here in 86, sell in 1990, stick your money in a CD, skip the down cycle, and get back in when the wealth phase turns green again in 1998. You get your next sell signal in 2007 before the next crash takes you under. You sit on the sideline waiting it out with your money safely in the bank until your next buy signal in 2013. For this comparison, you cash out in 2017. Look at that. Your profit jumps to $6,531,632, a 32,658% total ROI, and a crazy high 865% average annual ROI. LA, like so many other markets, have very steep up and down cycles. Capitalizing on the wealth phases while missing the crash phases generated $6.4 million more profit over your buy and hold. How about Washington, D.C.? Your buy and hold profit is an even $108,000. But when you enter and exit based on these green wealth phase charts, your total profit jumps to $1,803,254, an average annual ROI of 239% per year. That's an increase of nearly $1.7 million. Denver, Colorado. Your buy and hold profit is $108,933. But when you invest with the market, your profit grows to $948,986. Even though Denver only had 2 wealth phases, you were still able to ride both appreciation waves for an additional $840K in profit, simply because you avoided those big down cycles. Seeing a trend here? Detroit, Michigan. Your buy and hold results are actually a loss of $6,400. Imagine that. It couldn't even keep up with inflation. All that work, all that risk, and all that stress for all those years, and you can't even afford a McDonald's Big Mac out of the profits. Can following the wealth phases change your destiny in this Rust Belt market? You bet it can, to the tune of $1,043,209. Detroit never had any huge up cycles. They were more in the 5 to 10% annual appreciation range, but it had some long, nasty down cycles. Avoiding the 2.5 steps backwards, where your profits turn into losses, can be just as important as riding the gravy train up cycles. You went from losing money to making over $1 million extra in that one market, simply by being there at the right time, and not being there when the market was going south. Dallas, Texas. Dallas and almost all the other Texas markets had some of the lowest real estate appreciation rates in the entire country for most of the 80s, 90s, up until around 2005. On a statewide basis, only Oklahoma fared worse over that 25-year period. Even the Rust Belt states had more appreciation than Texas. So with that in mind, using the old buy and hold strategy, you buy in 1980, sell at the end of 2017, your real profit was only $12,145. In fact, when you account for inflation, you were underwater for almost your entire holding period, up until the last year. You can see from the chart here, Dallas only had 2 small wealth phases. The rest of the time, there was no reason to be in that market. What's that saying? You can't make a silk purse of a sow's ear? It's hard to build any wealth when your market is flat and declining for decades. Let's see if Housing Alerts can help in this situation. Following the green wealth phases, you buy in 98, sell in 2003. Since Dallas home values were declining in the 2004 to 2008 so-called housing boom, you didn't get back in again until 2014. And for the purpose of this hypothetical, you get out at the end of 2017 only because we need to do these comparison calculations. After a lifetime of waiting, Dallas is finally in a very strong upcycle. Now would not be the time to get out. Timing the market cycles got you $266,348 in Dallas. $250,000 more isn't as exciting as the extra millions you got in more cyclical markets, but it's still, 20 times more than that $12K you got from buying and holding? And your money was only at risk in the market for 9 of those years? Let's do the same thing for Casper, Wyoming, currently the worst market in the U.S. Your payoff from that long-term buy and hold strategy was actually a loss of $1,733. You held it all those years and didn't get a dime for your efforts. Now, what if you followed the wealth phases? Got your first buy signal in 1990, then your sell signal in 97, got back in 2002, and rode the next appreciation wave until it ended in 2008, jumped back in 2013, exit in 2016 when the wealth phase ends, stick it back in the bank until we settle up in 2017. How'd you do? $708,591 in profit this time. Not bad at all for what's currently the weakest market in the U.S. Now, there were lots of better markets during each of those times, but if you were stuck in Casper for some reason, following the wealth phases turned a $1,700 loss into a $708,000 profit. Okay, our last example is San Diego. I could keep doing this all day. The math works the same in any market. But you get the idea, right? Wealth comes from the up cycles and avoiding the down cycles. I love the San Diego chart. It's a fast-moving, very cyclical market. Using the old-fashioned buy and hold strategy, San Diego is like a decades-long roller coaster ride. And when you finally get off, all you made was $124,258. Not worth such a gut-wrenching ride if you ask me. I like to sleep at nights. But in a market as volatile as San Diego, following these wealth phases changes everything. Your profit jumps to $4,594,595, a 22,973% ROI. That's an average annual return of 609% on that initial $20K down payment. An extra $4.4 million from one simple change. You have lower risk and higher liquidity. You set it out when everyone else was getting clobbered in those down cycles. All we did in these examples was isolate the automatic appreciation every property owner would get in that market, and avoided the automatic depreciation, giving back profits in the down cycles, simply by being in the market at the right time. You did not add any value whatsoever, not when you acquired it, not when you held it, and not when you sold it. Now I know, some of you left-brain analytic types are probably thinking to yourself, there's got to be something wrong here. Why have I never heard about this? It can't be this easy, can it? Well, from one analytical geek to another, now that I put a lifetime of world-class research and know-how behind this, decades in the trenches doing big-time real estate deals, and don't forget the $1 million plus I've personally spent on housing alerts, now that I've got it all figured out and back-tested, now that all the hard work is done, and now that it's been market-tested and proven, yeah, it probably does look pretty easy now. That's because it is easy. Super easy. If you can read red, yellow, and green traffic signals and spot the green wealth phases, you've already mastered the most important part. We even have a version for our colorblind members, so you don't even need to see the shades of colors. Think about it. A kindergartner could tell you when the wealth phase cycles begin and end. You could have a child handling the most mission-critical decisions of your entire real estate business. With 30 seconds of training, they could watch for changes in the green wealth phase charts and shout out, "Hey Daddy, it's time to buy," or "Hey Mommy, it's time to sell." Couldn't you then just call a realtor and say, "I want to pay full price and buy an average house," or "I want to sell, just get me an average price"? Now I'm being a little facetious there, of course, but just a little. There's no hocus-pocus magic to this. It's exactly how wealth is created when you've got a leveraged asset that goes up in value. These examples were very basic. No real thinking involved, and no work other than buying and selling an average property at full price. When to get in and out of a single local market was the only variable. You could have outsourced everything, capturing the wealth while avoiding most of the risk and effort. That's it. It can't get any simpler. Listen, there are lots of things you could do to add value and improve on those numbers. Lots of ways to buy below market or with little cash in the deal. Lots of ways to own or control multiple properties. The main point is this: the market dictates your overall level of success or failure, not you or your investing techniques. Now, this is very important. It's not just about leverage and appreciation, although increasing your profit 10 or 40-fold is reason enough. Some of the biggest, most successful wholesalers in the entire country use housing alerts, and they swear by it. Normally, wholesalers don't even take ownership. They have a zero holding period. When markets are appreciating, there's lots of demand, lots of activity. It's a vibrant market. You can make every mistake in the book and still make a killing, still look like a genius. In flat or declining markets, it's the opposite. Work your butt off, take lots of risks, do everything right, and you still get clobbered. Hot and emerging markets are where you need to be, regardless of your investing tactics or strategies. In these examples so far, you limited yourself to only one market. If your market wasn't in a wealth phase, then you sat it out for years at a time. We call that being a local market master. If you're in highly cyclical markets, it's common to see these multi-million-dollar increases over buying and holding. As long as you've got these tools and can stay ahead of the cycles, you want to be in a highly cyclical market. Even in dead, declining, or flat markets, like we saw in Dallas and Casper, you'd gladly be a local market master and take an extra $250,000 or an extra $700,000 rather than losing money if those were your only options, right? But that's not your only option. As good as these local market master examples are, it is not how you create massive wealth in a short time. In fact, I'm against being a local market master as your main wealth-building real estate strategy. Why sit on the couch eating bonbons for most of your life, waiting for the next upcycle, even if it will put millions more in your pocket? It gets much better, wildly better. What if, instead of sitting out the market during your local down cycles, you rode other appreciation waves, time after time after time? We call that being a total market master. That's how you can turn the same $20,000 down payment into many millions, hundreds of millions, as you'll see. Instead of bank CD rates, you could be earning triple-digit returns on that same cash through leveraged appreciation in other hot markets, Every property qualifies. You only have to do one thing right. Know the local cycle. The problem used to be not knowing where to invest. But you saw how easy it is now to find these hot and emerging markets, right? One click in our hot market finder. The rising tide of automatic appreciation makes you very wealthy. The only difference as a total market master is you now do it in hot market after hot market. It can be combined with any forced appreciation or transactional income strategies you want to use. But rather than target hot deals, you first target hot markets. But before I show you how to become a total market master, I've got something even more important to your success I want to show you. These are screenshots of the brand new platform we're just now rolling out. If you're one of the couple 100,000 subscribers on our email list, that's why you haven't heard from me for a while. I've been obsessively reinventing a version of Housing Alerts for every class of real estate investor and property owner. Accurate and actionable local real estate market information shouldn't only be for the biggest, wealthiest, or most sophisticated investors. This was a massive upgrade that took us the last 3 years and a ton of money to complete. If this doesn't disrupt and forever change how real estate investing is done in the future, nothing will. How do you put a fair price on this? What's avoiding financial calamity worth to you? You tell me. What's it worth to make any real estate investing tactic or strategy work faster, easier, and better? You tell me. What's it worth to turn losses into hundreds of thousands, or millions, or possibly hundreds of millions, as you'll see in a moment? You tell me. I hope I don't regret this. Here comes either the best or the worst business decision I've ever made. I'm going to let you tell me what it's worth. Here's the deal. We were already knee-deep rebuilding Housing Alerts, simplifying it, when this book came out. Perfect timing. The book's main message was pretty simple. You can compete either by having the most useful, beautiful, high-end product, think iPhones, or you can have a bare-bones product and be the cheapest guy on the block, think McDonald's. But you can't do both. According to the book, a huge price cut will radically increase total sales. But according to them, the lower margins won't support a first-class, beautiful product. I beg to differ. It's not that simple. But I'm going crazy not knowing for sure. I think we can do both. We've done very well over the last dozen years, thousands of members. Our site may not have been the prettiest, but I can't think of anything more useful for real estate investors. We're the only ones who could have prevented the pummeling everyone took in the crash. And we're the only ones who accurately told you when to get back in. Market by market. Here's what Housing Alerts looked like over a decade ago, before that last crash. Sorry if they're fuzzy, I pulled them from an old video. I don't know whether to be embarrassed or amused showing you these old screenshots. We built everything from scratch, and the internet was still pretty young in those days. We only had 4 tools, these 4 here: charts and tables, the scanner, single city focus, and the screener. Now I will admit, it was built by left-brained geeks for left-brained geeks back then. It was geared towards very sophisticated investors and institutions, not homeowners or laypeople. The entire site was built around technical analysis graphs. Technical analysis, or TA for short. It's been around for a long time. Ancient Japanese rice merchants used it 500 years ago to track and predict the price of rice. At last look, there are 18,522 books on TA sold through Amazon, and I've read an awful lot of them. In case you don't know this, technical analysis is used to make over $4 trillion in global stock, bonds, futures, options, and currency trades every day. I'm the one who actually invented the formulas and algorithms using technical analysis to predict local real estate market cycles. Now, this is a pretty basic TA chart. Even if you're not familiar with technical analysis, you've probably seen charts like these in the financial press or on shows like CNBC. This one is a commercial real estate fund I follow in the stock market. But there are TA charts like these for any market, from pork bellies to oil and from Bitcoin to IBM. Technical analysis charts like this are what every Wall Street investment bank and global trading firm uses to outsmart individual investors. It's similar to what Housing Alerts does for every local real estate market, with one big difference. We make it really easy for you. We've turned those complex TA charts into simple ranking gauges and slider balls. You don't need to know a thing about technical analysis, other than TA is the only way to track changes in local market psychology. That's what drives supply and demand and causes real estate cycles. I've been a TA expert for decades, going back to Harvard Business School in the early 80s. So even if our original site was ugly, it kept a lot of investors' butts out of the fire and made anyone who followed the indicators very rich. Those 4 tools, I'm sure. You know what a national membership cost to access just these 4 tools back then? $1,997 up front and $97 a month. We did a major upgrade in 2010, but we still didn't raise our prices. It's been selling like crazy for over a decade. We even stopped accepting new customers at one point because we were bursting at the seams, but still didn't raise prices. Fast forward to today. Remember those 4 original tools? They no longer even make it onto our main menu anymore. They're buried here, inside these 2 classic tools links. We've made it so much better over the years. None of these sophisticated tools existed back then. Compare then to now. Instead of 4 tools, we now have 4 levels, entire suites of new tools and indicators. They're more accurate, more proven, and 100 times easier to use. Each level is targeted to specific types of real estate investors. The bronze level is for homeowners. Silver is for novice investors and most realtors. Gold has the hot markets finder, and Pro has it all. Listen, there's nothing more critical for success than what we do. If you don't know your market, you're sitting on a ticking time bomb. That's obvious now, right? We don't need to be the cheapest guys on the block because there is no block for us. We've got no competition. We're the only ones on planet Earth who can accurately predict local real estate cycles. And we're the only ones with a long-standing proven track record to back that up. We could charge tens of thousands more. I mean, who wouldn't pay $50,000 to go from a loss to over $1 million profit, or to go from a $150,000 profit to over $4 million in a single market like you saw in those local examples? You tell me. Why would real estate investors pay $30,000 or $60,000 for coaching instead of buying here first so they know where the hot markets are? Why invest blindfolded? You tell me. So here's why this may be the stupidest decision I ever make. Against all logic, we are going to compete against ourselves. That's right. We're going to dramatically cut, not raise prices, at least for today. It's been bugging the hell out of me since I read that book. I have to know, if we take away price as an objection, will 10 times more people come on board and start investing intelligently? Will backyard investors, homeowners, realtors, and even those who don't believe what they're seeing here finally open their eyes? Or will they continue to play Russian roulette with their retirement and their financial freedom? In theory, if we cut prices in half, sales should go up 5 or 10-fold. It's a no-brainer for me. How about you? Like I said, it may be the stupidest thing I've ever done. Just being real candid here, my worst-case scenario is that I find out it was a stupid move after all and tell our programmers to go back to those 2006 prices, or maybe try going the other direction and doubling them. This is our new dashboard. I'm logged in as a pro-level user with access to the entire U.S., all the markets. It's the highest level we have. You get everything. For this test, we're cutting prices across the board, including our top-of-the-line pro level. In fact, for the first time in our history, we've completely eliminated the upfront initial access fee. It's now all rolled into one price, depending on the number of markets and the desired tools you want. Our new bronze single city package is less than $4 a month on the annual payment plan. We're talking couch cushion change. If you don't at least jump on that offer, well, what can I say? We're just not going to be able to help you. Either way, here's your opportunity. It'll never get any better for you than that right now. I'm hoping this new a la carte ordering system helps you find the right combination of markets, tools, and prices to fit your investing style and your budget. So at least for today, right now, no one has any excuse for ever investing blindfolded again. Here's where you come in. We're planning a big, expensive rollout to unveil this to the public. First, we'd like to get your help answering the question, will adding different access levels and slashing our prices really increase our sales? We're going to do a beta test and pre-launch this in-house right now. The new indicators and tools are all built. We'll be adding new videos and other features. Other than that, we are ready to go. So I'm pushing out a new order form directly below, right now. If you're on some mobile devices, you may have to pause this presentation to see it or wait until the end. Let me give you a few pointers on selecting the best plan. This new a la carte order form lets you create the right mix of markets and tools to fit your investing style and your budget. Start by selecting your market level. Click on one of these 4 buttons: Cities, States, Regions, or USA up here at the top. The more markets you get, the cheaper they are. Your active selection is highlighted in dark green. The prices you see here are for the basic bronze plan, just to give you a rough starting idea. Once you've added your specific markets in the next step, prices will update instantly below. If you only want the city level, click here. You can add up to 3 different cities. The second and third markets are deeply discounted. Let's say you want to add Ocala, Florida, and Denver, Colorado. Click the state your city is in, so you'd click Florida, and then Ocala from this list. You can add more cities just by clicking on this list, or click it again to remove it. Since Denver is in another state, click Back to All States, then choose Colorado, then Denver. You can see your selected markets here. If you want to choose a different market level, or just to check out other prices, repeat those same steps. Prices get updated instantly whenever you add or change markets. To do that, scroll back up and click any of these 4 market levels in step 1. It'll erase your earlier selections and start over. Let's say you want all the markets in the South Atlantic region. So you click on Regions, then select South Atlantic by clicking directly on the map, or on these links below it. With this region, you get all 8 states in DC for one bundled lower price. Then confirm your selection here and scroll down a bit to step 3. Choosing between bronze, silver, gold, or pro determines what tools and indicators you get. There's a list over here on the right showing what's included in each level. As you move up from bronze to pro, you add increasingly more interactive and sophisticated tools. The levels build on themselves. The silver level includes all the bronze tools, the gold level includes all the silver tools, and so forth. Here's the nutshell version. The bronze level is the least expensive way to access our proprietary market indicators. At the core is our summary market scoring report. You'll get a separate report for each market you purchase. Here's what it looks like. Everything is on a single page. The master score gauges show where each city ranks relative to all markets in the country, across all indicators. The TAPS indicator, short for Technical Analysis Point Score, is one of the ways we convert complex TA charts and algorithms into a simple-to-understand slider ball. You can see in an instant how weak or strong your market is. The TAPS gauges show your market's rank against all markets in the country. The 1-year and 4-year THAR gauges, that stands for Total Home Appreciation Rate, shows each market's rank in terms of its spot appreciation rates. The STAR Momentum Traffic Light system shows the last 15 months' activity and its relative ranking. These traffic lights are early warning signals of changing conditions. And the local TAPS and wealth phase charts help you decide when it's time to double down and get aggressive and when to back off or even exit a market completely. When these indicators are strong, you can more safely reach for deals, get more aggressive on the acquisition side, get more leveraged, and do more deals. Weakening indicators mean the opposite. It's time to lighten up, or insist on better, safer deals, or exit the market completely. This one report gives you all the essential market data in a very easy-to-understand format. The bronze level also includes these other tools and services you see here, outlined in red. Now, you're looking at my dashboard while I'm logged in as a pro user. As a bronze member, the silver, gold, and pro tools won't be accessible. They'll be black and white on your dashboard. In addition to the market report, ranking gauges, and wealth phase charts for each of your local markets, you have access to the national market overview and our quarterly analysis of the best and worst states and regions. You also get all the starter tools like education and tutorials and free admission into our closed affiliate program. This affiliate program is an important benefit and a quick way to get your membership for free and have us paying you each month. Our affiliate program is closed to the public. You must be an active member to participate. We make it real easy for you to refer anyone to Housing Alerts and earn huge commissions. We pay you 1/2 of their entire initial purchase. Let me say that again. For any and every new member who comes to our site and purchases a membership because of your referral, we will send you 50% of their initial upfront purchase. You can earn $648 or more on a single purchase. There's no limit on how much you can earn for as long as you remain an active member. All you do is refer new members to us. Now, if you aren't familiar with affiliate programs, This one is incredibly easy. We give you a special tracking link. Think of it as your unique web page we create for you. Then, you simply include your special link anywhere you come in contact with other real estate people. Add it below your email signature, post it in real estate forums or on Facebook, LinkedIn, or Twitter. Post it on any social media site. That's it. Some members include their link on business cards and flyers they hand out at real estate events. If you've got an email list, even better. We've got real estate investors making tens of thousands by mailing to their buyers list. We have lots of free training and support inside your members area. You may not know this, but the vast majority of our sales come from affiliates just like you. Once someone clicks on or types in your link, your job is done. We take it from there. It's about as easy as it gets to make a lot of fast, quick cash. One affiliate sale can more than pay for your entire membership. We actually have members who aren't even real estate investors. They join solely for the right to promote housing alerts through this private affiliate program. It's a high-converting, easy sale. We do all the work. All you do is share your link with like-minded friends and colleagues. No one involved in real estate should ever be without housing alerts. You're actually doing them a big favor turning them on to this. The fact that you get paid for doing it is icing on the cake. Okay, back to the order page. The prices shown here are for one region. You can add up to 3 regions and you get huge discounts on the second and third ones. There's about 100 local markets in the South Atlantic region, so that works out to a few bucks per market. The silver level gets you everything in bronze, plus all of our mapping. If you're an investor, the zip code maps alone make it a no-brainer. In a few seconds, you can instantly know exactly where the best and the worst micro markets are. Here's what those zip code maps look like. You can zoom way in or way out and watch micro trends develop and change over time. Here's San Francisco's zip code map. You can see quite a range in appreciation rates. The hottest zips are those in the yellow, orange, and red colors. Here's the Washington, D.C. area. I used to do a lot of investing in the D.C. market. Southeast D.C. and adjoining PG County in Maryland were always the weakest zip codes, and you can see how that trend is currently reversed. Those green areas are the strongest zip codes now. Here's Nashville's zip code maps, one of the hottest markets in the country. As you move away from city center, sub-markets get weaker, a few are even declining. In Tampa, Florida, this map shows a lot of hot sub-markets in Tampa and a few weak pockets you want to avoid. These zip code maps can save you months and years trying to figure out what are the best areas to focus your time, money, and effort. They're especially useful if you send acquisition mailers or if you just want to be in the hottest micro markets and avoid the worst ones. There are other tools and maps you get with the silver level. You can map each indicator, the Dream, the Star Momentum, TAPS, and Master Score maps to instantly spot strong and emerging markets or weak declining markets all across the country. Or watch markets in motion like time-lapse photography and see the path of strength or weakness develop. Spot market trends from 30,000 feet. When you combine these maps with our sophisticated market prediction algorithms, you've got the gold level. The gold and pro levels are where the full power of housing alerts gets unleashed. At the gold level, you enter the world of algorithmic hot and cold market filters. That's a mouthful, I know, but there's millions of calculations going on behind the scenes. No human could come close to doing what the Hot Market Finder does in a single click. You can now pinpoint and rank every real estate market in the country using multiple proven and back-tested indicators. The most powerful tool inside the gold level is our brand new Hot Market Finder. Here's the top of our Hot Market Finder at the time we recorded this. These are the strongest Master Score markets. And here's the middle of the pack in that same Hot Market Finder. The changing colors help you find very early stage, emerging, and crashing markets. And here's the bottom of our Hot Market Finder, the declining and crashing markets, the ones you should avoid. And of course, there are hundreds of markets in between if you've got the national level access, all the markets in the U.S. In the gold level, you also get state and regional market radar tools. Think of Hot Market Finders for entire states. Also included with the gold level, complete market reports for every state and every region, along with other dynamic mapping and table tools. If you're a serious real estate investor, you should be a pro member. It's our top-of-the-line suite of local market analytics and the only level we've ever offered until now. It's what I built for myself. It's exactly what you need to completely analyze and invest intelligently anywhere in the country. The pro level is interactive. It's where I do my research, where I drill down into any market, and it's what I use to produce all the custom charts, tables, and reports you see in my training videos. The bronze and silver levels were created for homeowners, realtors, and backyard investors so they could have basic access to market indicators without having to buy all the powerful investor tools. If you're an investor seeking to create wealth in the fastest time with the least capital, effort, and risk, you want these powerful tools. I'd need a separate video just to show you all the pro-level tools in action. You get everything we've ever developed. And as a pro member, you'll also continue to get everything we develop. Every new tool, indicator, and micro market we add in the future goes right into the pro members area at no additional cost. We don't hold anything back. We don't have anything else to sell you. The pro level is our top of the line product. You'll get everything we've got now and in the future. Regardless of your particular type of real estate investing, it all begins and ends with your market. My strong recommendation is that you go with the pro access and add as many markets as you can afford. Now, once you've decided your access level, click on it and then scroll down to choose your payment plan. This step is easy. Choose the annual subscription. It's far and away the best deal. Whether you choose the annual subscription, the one-time payment, or the monthly payment plan, your access to markets and tools is exactly the same. We only offer the one-time payment for those who simply refuse to ever do any type of recurring subscription. You get 12 months access, then it ends. No recurring billing. But just be forewarned, it costs more, and you don't lock in your price forever. You aren't even guaranteed to get back in, or if we'll even offer this again. The monthly subscription is for those wanting to spread the cost out over the whole year. If you have an annual or monthly subscription, we'll never raise the price on you for as long as you remain an active member, even as we add new tools, markets, or upgraded services. And you can cancel at any time for any reason. You'll never receive another charge. After you enter your contact info in Step 5 and review your order in Step 6, then click on the Checkout button. Then, on the next page or new tab, please enter your payment info and remember to click the Place Order button. Your login will be emailed to you right away. And welcome to the world of intelligent investing. If you have any problems or questions, you can use the live chat up in the top left or email us, sales@housingalerts.com, or give us a call toll-free, 800-210-0667. Okay, you ready to become a total market master, riding the appreciation wave from hot market to hot market? So far, we've only discussed single markets. We started in Seattle, we ended in Seattle. We started in Dallas, we ended in Dallas. When we experienced a down cycle, we intentionally limited ourselves to only one option, putting our money in the bank and waiting it out. How powerful do you think these tools would be if, instead of waiting it out for years, you invested in other hot markets all over the U.S.? What you're about to see was never really possible until now. Without the local market precision you get with Housing Alerts, there's no way you could successfully know when to get in and out of local markets. First, let's see what you'd have if you'd invested that same $20,000 in an average market in the U.S. from 1980 to 2017 and just held it. Technically, you can't actually invest in an average U.S. market because there's no such thing, but it'll work for comparison purposes, just to give you a baseline. We're using the same assumptions we used earlier in our local market master examples, except we're only looking for an 80% LTV mortgage this time. We're going to put down 20% and borrow the remaining 80%. That's a 5-to-1 leverage multiplier. See the chart in the lower left corner? That shows the ups and downs of the U.S. overall market. Remember, real estate cycles are like 3 steps forward, 2.5 steps back. You make money, then you give most or all of it back. On an inflation-adjusted basis, you'd realize a total profit of only $31,331 during that entire holding period. That's a 157% ROI on your $20,000 investment. That's a measly 4.2% average annual ROI. Now, let's step inside the modern world of real estate investing. We'll follow the same model we started with. So we check out our market report tools, which tells us the Nassau-Suffolk market is about to enter a wealth building phase. Let's see what you would have made as a TMMer, a total market master, if you lived where you wanted and invested where it was best. You invest that same $20K in a property in Nassau in 1981 and purchased it full retail price. You hold it, adding no additional value whatsoever. You're just riding the automatic appreciation wave every property owner gets in that market until 1987, when you start getting signals this wealth phase is coming to an end. So you sell. Your profit from that initial $20K down was $137,048 just from automatic appreciation. You also got back your $20K investment, so you have roughly $157,000 to reinvest again. As total market masters, you're no longer limited to only your local area, are you? Nope. You can now invest anywhere in the country where your money will grow the fastest, safest, surest. How do you know where the best places are to invest? No problem. You check out one of the other tools in Housing Alerts. We'll use the pro-level Dream Tool this time. In 1987, Los Angeles looks like a great place to put your money. So you invest your $157,000, you buy in 1987, and sit back. In 1990, you get your exit signal, so you sell. How much did you make? How about a $298,838 profit? Let's add back our initial investment, and you now have $455,886 to reinvest in the next hot appreciating market. You pull up your gold level hot market finder software, and in less than a minute you find Portland, Oregon. You invest your profit along with your original $20K in Portland, Oregon, then sit back and watch. 1998 rolls around and it's time to sell. How'd you do? You'd realize a profit of over $1.1 million from Portland, for a total profit so far of just over $1.6 million. Can you see how this works? All you do is go from hot market to hot market and ride the local wave. Remember, you're buying at full retail, adding no additional value, putting 20% down, and simply waiting for the next signal. The FAR, gap, ham system in all its glory. It doesn't get any easier than this. Okay, so you pulled your profits out of Portland, checked the star momentum indicators, and found that San Diego is looking sweet. So you invest your $1.6 million in San Diego, and you ride the wave until 2005 when you see hotter markets to pursue. How much profit did San Diego give you over those 10 years? How about $10,949,891, almost $11 million in profit simply from being in the right place at the right time, on purpose. No guessing, no gambling, just following the trail of hot markets. Adding back your $1.6 million, you now have over $12.5 million in cumulative profit to reinvest. Remember, we're still in the same period that we used when we were looking at our single city examples, investing only locally. Can you see the difference when you leverage all of the markets available as a total market master? So here you are now, with over $12.5 million to invest. What do you think we do next? Yep, look for the next hot market. Let's get out your hot market finder tool again, and after a couple of minutes of research, you find Odessa, Texas in 2005. You invest your $12.5 million in Odessa, and you get the signal to sell in 2009. How much automatic appreciation did Odessa, Texas give you? How about over $24.1 million in profit? $24,165,222. That's the beauty of real estate. If you combine automatic appreciation with leverage, it doesn't take long to double or quadruple your investment. Remember our leverage example earlier? 10% appreciation and a 10-to-1 leverage ratio doubles your equity each year. We're keeping it real simple here, using the FAR gap ham system. Find an average realtor, get an average property in a hot appreciating market. Our example captures the automatic appreciation each market gives you just for being there. We ignore forced appreciation and value-added strategies completely. In hot markets, you can get much more aggressive than we did in our simple example. For starters, you can do no money down deals or rehabs with cash out refis to control multiple properties. Tax sale investing works infinitely better in hot, vibrant markets. Investing in notes is far more secure when the collateral is appreciating. Wholesaling can actually be profitable in hot, active markets. Multifamily and commercial real estate trends follow residential. You can and should use this for any and every real estate investing technique. Appreciation is the sweet sauce that makes everything else work. There's no limit to what you can achieve. Now, altogether, you've made over $36.7 million so far. In 2013, when people were bemoaning the demise of any good real estate deals, you sifted through the markets with your Housing Alerts tools and found Reno, Nevada, of all places. You invested your $36 million and sold near the end of 2017. Reno gave you almost $130 million. As a total market master, all told, you've now made $166 million compared to the $31,000 you did over the same time period as an average investor, oblivious to individual market cycles. That's an 833,000% ROI compared to 157% ROI. Did I say that right? An 833,000% ROI. Yep, turning 20K into 166 million will do that for you. That's an extra 166 million from investing smarter, letting automatic appreciation do all your heavy lifting. Under the old way of doing things, you earned $1.57 for each dollar you invested. Under this far gap ham example, you earned more than $8,000 for each dollar you invested. You didn't use any special real estate skills or tactics. You didn't send out thousands of mailers looking for distressed homeowners. You didn't knock on doors or post bandit signs all over the neighborhood. You didn't do any inbound or outbound marketing. You didn't post to Craigslist or maintain any buyer-seller websites to generate and manage your leads. No bird dogs. No virtual assistants. You didn't go down endless dead-end paths being jerked around by buyers, sellers, and banks. You didn't risk violating all the new foreclosure and seasoning laws. No A to B and B to C closings to orchestrate. No complex, stressful financing to arrange. And no working like a dog jumping through hoops for months, only to find out months later it was all a wasted effort. In fact, you didn't invest much of your time at all. You simply found an average realtor, got an average property in a hot, appreciating market. You only had to get one thing right, the ham, the hot, appreciating market. And we've done that for you. One small, simple change can take you from $31,000 to $166 million, from 157% ROI to an 833,262% ROI. Sound too good to be true? When you boil it all down, all we're doing is avoiding the times where you give all your profit back and replacing it with leveraged returns from being in an appreciating market. Obviously, in this example, you eventually own too much real estate to buy and sell on a single day. There are typically lots of hot emerging markets and lots of flat and declining markets, all at the same time. We used a single hot market to make it easy to follow. In reality, you could be spreading that portfolio amongst multiple hot markets. And you can estimate for yourself how much better your results would be if you bought properties at a discount, or put less money in the deal, or started off with more properties. Imagine your results if you combined some of the great forced appreciation strategies and actually added value. Most important, please remember that you can do everything right year after year, but in this volatile market, it only takes one mistake to wipe out a lifetime of success. I've personally seen many smart, super successful real estate investors, inches away from retiring, get completely wiped out in local down cycles. At last check, there's something like 100 different home renovation and flipping shows on TV. We're seeing a huge influx of new investors and wannabe home flippers. I really hope each of you succeeds beyond your wildest dreams. Real estate's a great career. I've done it all my life. Haven't had a boss since the early 80s, if you don't count my wife. Some of you probably take exceptions to my mantra. It's the market, stupid. You may think, this time it's different, or I'm only in it for the cash flow, or investing for appreciation is speculation, or I'm a wholesaler, markets don't matter. To those who still believe in those outdated mottos, stop. Open your eyes. You are wrong. Of this, I am 100% certain. If you continue to invest blindfolded to the market, you will fail. In many cases, you'll fail spectacularly, forced into foreclosure and maybe bankruptcy like millions of wholesalers, flippers, and buy and holders did a few years back. Being over-leveraged in a declining market is the kiss of death with no escape hatch. Or you'll fail slowly, living a frustrated life full of stress and hard work, never knowing why you aren't tasting the same easy success you hear about or see on TV. Either way, failure is failure. Your spouse, your mother-in-law, your family and friends, even your children will see you in a different light. You will look at yourself differently. I wasted a big chunk of my early real estate career, my life, investing in flat real estate markets. Back then, I didn't know any better. No one knew any better. And I'm not saying this because I want you to buy housing alerts. I'm at a point in my life where, honestly, it just doesn't matter. I'm telling you this because that pain is avoidable. Why shouldn't you succeed? Well, what you've seen here is your key. It's exactly the same thing I've told my children and anyone I've loved and cared for. I've invested over 100,000 hours of my life learning and doing all things real estate. That experience can save you a lot of painful lessons and heartache, if you let it. The world isn't flat anymore. Hurricanes don't show up unannounced anymore. Technology has changed everything. Why would you still invest oblivious to your market? If you don't get the significance of what you've seen here, investing intelligently with local cycles, you'll learn it sooner or later, the hard way. So I'll close with this. We've got a highly trained, full-time team dedicated to helping you succeed. Orsini has been with us since 2005. He's a world-class programmer and our chief software architect. He's become one of my best friends. I can still kick his ass mountain biking, though, as long as we're going downhill. Amir's in his 11th year full-time with us. He started out in customer support and is now our jack of all trades. Leanne is now in her 6th year full-time with us. She runs our customer support operations. I'm very proud of what she's done. She's the queen of customer satisfaction. Seriously. Barely a day goes by where she doesn't get a glowing thank you reply from a member. I've never seen an angry word from any customer. With an internet-based business, with as many customers as we have over so many years, that's really saying something. She and her team bend over backwards to keep everyone happy. Robert started with us in 2010. He supports Leanne and the customer service team on the technology side and runs the traffic and conversion side of the public website. Francis is also in his 6th year, full-time devoted to customer support. Dale Sue is my boss, like I mentioned earlier. She does whatever she wants. She also keeps me from getting too technical or going down nerdy rabbit holes on presentations like this. Or maybe I should say, she tries her best to keep me from getting too nerdy. Serge works full-time keeping all our web properties looking beautiful on any device. Josh is our technical guru who keeps all the systems talking to each other and builds our sophisticated customer support apps. Marco is another key full-time member of the customer support team, whose only job is to make sure that all of our members stay happy. The last pretty face here is yours truly, along with Chester and Buford, 2 of our rescue dogs. We've got a small horse farm in Ocala, Florida, with a really nice office I just built. My dogs hang out there all day with me while I work. I love what I do. I hate leaving the farm, not working. I wake up each morning like a kid at Christmas, excited to change the face of real estate investing. Here's some of what we've got in the project pipeline right now, why I jump out of bed before the sun comes up. We're adding around 40,000 micro markets and another 3,000 county-level markets into the mapping system. We're creating a customizable command center where members can pull in data, indicators, and widgets personalized for their own needs. Once that's done, we'll start building a customizable alert system so pro members can create their own alarms, triggers, and watch lists to help you run this on autopilot. These are big projects. We'll roll them out to pro users at no additional cost. So I guess you can call that work, but for me, it's living the dream. One final reminder, so there's no confusion. Please know that I'm dead serious about this a la carte menu idea and getting rid of the upfront initial access fee. This is a temporary test. Anyone who gets in under this test with an annual or monthly subscription can stay in, and that price is guaranteed forever, so long as you remain an active member. Lock it in while you can. Why not create that generational wealth you want? Real estate can get you there if you work with, not oblivious to, your local market cycles. Welcome to the world of intelligent investing. If you have any questions, you can use the live chat in the top left or email us at sales@housingalerts.com or give us a call toll-free 800-210-0667. Thanks.